Hello, I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, one of our most esteemed guests. He has a huge resume, and I'm just going to gloss over it. He is a professor of economics at Boston University. He worked in the Reagan administration, the first Reagan administration, as a Democrat, actually. And his name is Dr. Laurence Kotlikoff. Dr. Kotlikoff, thank you for joining us today on USAWatchdog.com.
Great to be with you. I just want to make clear I'm not really political, so I thought the President Reagan needed, the country needed some help in the area of economic policy thinking, and so I went down to work. I didn't vote for President Reagan, but I tried to help.
That's okay. I just wanted to say that, they don't put the stupid people in the Reagan administration or the Bush administration or the Clinton administration. They usually generally don't put the dumb people to work for the president. And so that's the point I was making. You have a very huge, very deep resume, and I'm just glossing over the surface. No, I understand you're not, you're kind of apolitical these days, and we'll get to your Inform Act, but I really wanted to talk to you about some of the articles you have written, which really have just slid under the mainstream media radar, or even the alternative media radar. And I am shocked about your, I'll just read the title. SIPC insurance scam, another reason to close your brokerage account. Of course, we're talking about the Securities Investment Protection Corporation. They only have about $1 billion or so in there to cover trillions of dollars. But you're saying that now in our pre-interview that, it's not really insurance anymore. It's more of a way to wring money out of customers. And you're talking about another reason to close your brokerage account. Please explain.
Okay. Well, in the aftermath of the Madoff scandal, SIPC was short of money. They had been collecting premiums, for example, from companies like Goldman Sachs or JP Morgan of $150 in total per year. And then they were claiming to be insuring, tens of thousands, millions of brokerage accounts through the 4,000 members, brokerage firms that are members of SIPC. So you have SIPC, which is a institution of Wall Street. It's owned and operated by Wall Street. It was set up under a federal law, but it's really a Wall Street entity, promising to insure, protect our brokerage accounts up to $500,000 if our money is stolen, if our securities are stolen. And what happened is that Madoff occurred, and they had lots and lots of people that were asking for their insurance protection. And SIPC, since it had been collecting so little money, didn't have enough money to cover it. So what did they do? They decided to come up with a means not to pay the insurance guarantee. So the way they have worked things through the courts, and they've spent a lot of money on high-priced lawyers and gotten court decisions in their favor, have left us in a situation today that's not really connected to Madoff or their handling of the Alan Stanford Ponzi scheme, which is another incredible scam that they engaged in. But the current situation today is that if anybody has a brokerage account, and there are lots and lots of people who have brokerage accounts in our country, and you can have a brokerage account through your IRA, for example. If you have a brokerage account and it's insured by SIPC, and it's most likely insured by SIPC, then you are at great risk of the following happening. You put your money in maybe decades ago. It does well, earns the kind of return that you can expect over time in the U.S. market. And you take some of it out, and maybe you take out more than you put in, because that's the basic idea of saving and investing, that you get to take out more than you put in. That's why you're investing, right? So you take out money. They discover a fraud. Maybe it could be up to 6 years after you've taken the money out. Maybe 5 years and 354 days, or 55 days before you have this fraud discovered. And now you are told, well, look, every dollar you took out in the last 6 years, which is, almost 6 years ago, you took out some money. And if that money exceeded what you put in, you have to pay everything back. So you can't...
Because they discovered fraud at the brokerage.
They discovered fraud. The brokerage had nothing to do with you. 6 years later, up to 6 years later, they can ask for really all the money that you took out over the prior 6 years. And so you can't safely spend your assets. They accuse you in effect of being a thief, a partner to the fraud, because they're prosecuting you through the bankruptcy laws of New York State. And in addition, if you still have money in this brokerage account, they'll say, we owe you nothing in terms of insurance, of the $500,000 insurance obligation, because you're quote, a net winner. So they have made the Madoff victims into victims. And to further, they've victimized the Madoff victims, and now they're victimizing the Stanford victims. And if you look at the history of their response to fraud as it's been discovered, they've been fighting tooth and nail never to pay a dollar. So the situation is not that we just don't have any insurance system here for your brokerage account. It's far worse. It's that if you spend any of your money, you could have it. If you withdraw your money and spend it, and you don't have it to hand back to them if they sue you, you could be in very bad shape, because they can come after you and they'll sue you. So just to give you kind of a concrete example here, suppose 40 years ago you put in a couple $100,000 into a brokerage account, and over time it grew to maybe today it's $2 million. And let's say over the last 6 years you took out $800,000. So you have $2 million in the account today left over. You took out $800,000. You put in $200,000. Now they discover a fraud, and there's a Ponzi scheme being discovered every 4 days. So they can declare the fraud a Ponzi scheme very easily.
Wait, stop. There's a Ponzi scheme on Wall Street being discovered every 4 days.
Yeah, that was reported in the New York Times a couple of weeks ago. I'm not making it up. Okay?
Oh, my goodness. I know you're not making it up. I just wanted to clarify that point, that this isn't just some, Madoff a one-off thing, Stanford a one-off thing. No.
So,
every 4 days you're saying there's some Ponzi scheme, which is fraud, every 4 days in Wall Street.
Right. So here you put in $200,000 40 years ago. You're 70 maybe. You're about to retire, and you're counting on the $2 million. Maybe you took out $800,000 in order to help your sick brother with cancer, or maybe to give it to charity, or whatever you did, maybe to put your kids through school. Anyway, you don't have the money anymore. So you turn to SIPC and say, look, I just lost $2 million. Pay me $500,000. That's what I invested on the basis of that. I was protected. When I went into the brokerage, I see this little plaque that says SIPC insured, and that's what I was told. So give me the $500,000. They say, no, you took out $800,000. You put in $200,000. You are a net winner. You took it out over the $800,000 over the last 6 years. So you're in effect a thief, and therefore we are not going to insure you on the $2 million. We're not going to give you the $500,000 to cover the $2 million loss. You get nothing there. Plus, you have to pay us back $600,000. So you're at double jeopardy here. It's not just that you can get totally screwed by a brokerage firm, which is happening as I said, every 4 days some Ponzi scheme is being discovered. But you can also be at great jeopardy by SIPC itself. So they are running a complete insurance scam. It's a disgrace. There is a bill in front of Congress that would correct this, but so far the members of Congress haven't pushed it through.
It's unbelievable. I mean, it's almost like you wrote your Tom Clancy. I mean, like you're making it up. I know you're not. But it's just unbelievable how the SIPC has been turned into, from insurance to a way to wring money out of you for the ill created by Wall Street, their overseers. That's what this is. It's no longer insurance. It's a way to expose you to losses and lawsuits by SIPC, not to insure you.
It's trying to divert the attention from SIPC. It's saying, they're saying these people were winners. It's not earning a decent return on your investments is not being a winner. It's just having a normal economic life. That's what you're supposed to do. You're supposed to save and invest and enjoy the returns of your investment. So to be called, to be labeled a winner and not a victim, and then to be told that your remaining balance is totally uninsured and that you have to pay back up to everything you took out over the last 6 years, depending on the way it's set up, depending on the numbers, Yeah, it's just disgraceful. But it's also very, very dangerous. So nobody should have a brokerage account today until this bill, which I'll give you the number. It's HR 3482 and also the Senate Bill 1725. If that bill is called, it's called the, let me get the exact title for this. Well, it's going to take me a second to come up with it. But anyway, it's a long title, but it actually restores protection to brokerage accounts and forces SIPC to do its duty. But right now, nobody should have a brokerage account. They should close it immediately and not spend your money for 6 years. Because if you spend your money, if you've made a return on your money and you take it out and you spend it, including the principal and the return, they can sue you for every dollar of return, which could be far beyond what you put in, because that's, compound interest. And if you're retired and if you've been putting, this is the worst for retirees because, first of all, they can't go back to work. Secondly, they're in the worst jeopardy because they've had a longer time to accumulate return in excess of what they put in. This is called the net equity clawback. And it's a disgrace, and that's exactly what's going on.
And if your brokerage doesn't engage in fraud, let's say you're in one of the brokerages that is one of the more, top drawer brokerages, something like Edward Jones, they have to be, engaged in fraud. You're more safe in one of these other brokerages, are you not, or are you not safe at all?
You're not safe in any of these companies, whether it's Edward Jones or I think even Fidelity Investments. A lot of these companies are self-custodying the money, so you don't know exactly what they're doing. You don't know if they're taking your securities and borrowing against them. You may have signed some fine print that allows them to hypothecate your securities, and then they could borrow money, put it in a big bet which wasn't quite authorized, wasn't quite appropriate, and now they've lost all the money, and the brokerage goes under. The firm goes under. Now that could be called a Ponzi scheme, because a Ponzi scheme is taking money in and taking new money in to use, pay off old people, older people are trying to get their money out, but also to not be properly investing the proceeds. So anything really can be called a Ponzi scheme. And if you call something a Ponzi scheme, the courts, thanks to SIPC, have now set things up so that you can be clawed back for up to every dollar that you put in over the last 6 years.
That is outrageous. I mean, when you walk into your brokerage office, SIPC should say, we're going to come after you, not we're protecting you. That's what that means now. It means, forget about protection. We're able to come after you for anything. That these guys, that people that you're investing your money with, SIPC can come after you for any losses that are deemed a Ponzi scheme.
Yeah, they can come after. Well, you have to have taken out more than you put in, but that's what you're supposed to be able to do by investing in a brokerage account. I mean, you don't invest in a brokerage account to take out less than you put in, right?
That's right.
Nobody does that. So we've got a situation where Wall Street, unless this bill is passed, again, it's HR 3482 and the Senate Bill 1725, everybody who's got a brokerage account should, A, move their money out, and B, get their brokers to demand that Congress pass this bill, because it's not going to be safe for anybody at any point in time for the infinite future to invest in a brokerage account unless this bill is changed, or unless SIPC is put out of business entirely, which would be better than the current situation. So the bill's called the Restoring Main Street Investor Protection and Confidence Act. The SIPC has been engaged in such fraud that even the SEC, the Securities and Exchange Commission, has gone off and sued SIPC to try and get them to pay off the legitimate claims of the Stanford victims. Alan Stanford was ran the second largest Ponzi scheme after Madoff.
I think it was $8 billion, wasn't it? Something to that neighborhood.
And he was discovered in January of 2009. Madoff was discovered, I think, in the fall of 2008. So they were kind of back to back. And in this case, we had thousands of Americans who were invested with Stanford, and what Stanford did was sell them certificates of deposit. So now there's some details about the actual nature of those CDs, but basically it was Stanford brokers who were publicizing the SIPC protection left, right, and center on their coffee mugs, on their pencils, on their pamphlets that they were handing out. SIPC was plastered everywhere, so people thought they were insured. They buy these Stanford CDs, and then the Ponzi scheme is discovered, and people turn to Stanford, to SIPC to get the $500,000 of protection, and SIPC says, we owe nobody anything, not a penny. We owe nothing to any Stanford victim. Why? Because they've gotten the District of Columbia Circuit Court, the D.C. Circuit Court, to rule in their favor, in SIPC's favor, which is that because people bought CDs from Stanford, they were actually making a loan to Stanford, not buying a security from the brokerage firm. So get this. You put your money in a brokerage account. You think you're buying a security. It's stolen. You go and try and get the insurance from SIPC, and then SIPC says, no, you didn't actually try and purchase the security. You actually just made a loan, and therefore you were a partner in the brokerage firm, and you just invested with Stanford. You were a partner of Alan Stanford, and the fact that the firm went under means, well, you're just a creditor that went under. You get the point. This is just a horrendous interpretation of the circumstances here.
Well,
yeah.
Well, not to interrupt you, but some people may say, well, I wasn't involved in Stanford. That's only, some crazy Stanford and Madoff. But let's get into one of your other articles you wrote, and you titled it jpmadoff.com Fraud Street. And, of course, for people who don't realize that J.P. Morgan paid fines and restitutions of about $2.5 billion, and some of those fines were paid to avoid criminal charges. That was widely reported. So even if you don't go in with, Sanford or Madoff, you may be working with J.P. Morgan or some other big bank, and you're saying that, well, same rules apply for SIPC. If you get caught in, one of these big banks helping one of these companies commit some sort of fraud. And obviously, J.P. Morgan did help Madoff knowingly or unknowingly.
Oh, well, I think J.P. Morgan knowingly laundered Madoff's money. They were the banker for Madoff. They knew that money was being put in there and it was supposed to be invested in securities, and they knew it wasn't being invested. They knew it was being wired to other places that were not. So they knew all this for many, many years, and they kept quiet. And they really violated our laws in so doing, and nobody was prosecuted. God forbid anybody that our Justice Department actually send anybody to jail for financial fraud. That's an extremely rare thing to happen.
Dr. Kotlikoff, don't you realize the FBI's busy with celebrity nude photos? That's what's important, not trillions of dollars in fraud, as I say sarcastically.
Right. I mean, the record of Wall Street, every day we're reading about some big bank being fined billions of dollars. I think last week it was $16 billion fine that the Bank of America had to pay for selling fraudulent securities. They promise to be selling you a security that's doing this, but it's actually not. They know they're selling you snake oil, and they're getting away with it. Nobody's going to jail. And it's just been one, if you look at the SEC's actions, if you Google SEC financial actions, you'll find that something like 700 cases were brought by the SEC, and fines were, in many or most cases, levied. And some of these are in the billions, and some are small, depending on the size of the fraud. But this is, I call Wall Street at this point Fraud Street. And one of the biggest rackets, again, is the SIPC brokerage account insurance, which is not really insurance. It's a means of pretending. When you tell somebody the account is insured, then you're giving them the basis for safely investing or more safely investing. You're giving them an assurance, and then and then the fraud occurs, and then Wall Street through SIPC says, "Oh, we owe you nothing." That's a scam.
And you need to pay us back. We're going to sue you.
And we're going to sue you. Yeah, that's That's what we call an insurance scam. So SIPC, Wall Street through SIPC has been running a massive insurance scam. It's really, and again, any kind of insurance or financial scam can also be labeled a Ponzi scheme. So in many ways, you could view SIPC as running its own Ponzi scheme. Because when you promise to pay, you take in $150 a year from Morgan Stanley in insurance premiums to insure all the whatever, millions or whoever, tens of thousands, who knows how many brokerage accounts Morgan Stanley has. You take in just $150 to insure all of them. That is prima facie evidence of a scam that you're running, of a Ponzi scheme, really, because you're taking very little, you're getting people to do something, and not being able to deliver on the other end.
Unbelievable. I mean, this is just frightening information. And coming from you, and I just want to tell everybody that you're a professor of economics, you are a mainline, well-respected guy, and so I'm going to go to the bank on what you're saying.
Let me also make clear that, I have relatives and friends, and I've said this in my columns at Kotlikoff.net. I have friends, colleagues from the university. Elie Wiesel, who's a colleague at Boston University, lost his entire endowment for his foundation was invested with Madoff. So relatives, friends, colleagues of mine personally invested. So you might say that I'm not neutral. I don't think any American should be neutral in this context because this is outrageous. I mean, this is something that, but also very scary for anybody who's investing in a brokerage account. The other thing is you look at like Fidelity's website and you look at what they say about SIPC insurance. They say that they have additional insurance if SIPC runs out of money or can't pay you. But if SIPC rules that you aren't owed anything, their insurance doesn't kick in. And then the amount of insurance, additional reinsurance, if you like, that they carry is laughably small. So, and we have rogue traders in these companies who bring them down. Barron's Bank was brought down by a guy named Nick Leeson. This was the oldest bank in the world. Barron's Bank of Britain, of England, the oldest bank in the world. In one trade, this guy brought down the entire bank, and it's no longer in existence. It's gone, thanks to one guy. So one trader on a brokerage floor could bring down the entire firm. And you took out your money pretty much 6 years ago, and now you're told whatever money you've got left, it's not insured, and furthermore, you have to pay back up to every penny you took out. That's not America.
I want to move on to another giant fraud, and I just want to wrap up the interview with this, and that is the Inform Act, where you had gotten, 100 mainline economists, prestigious.
1,200.
Excuse me, 1,200. I'm sorry, 1,200. 10 of which were Nobel winners in economics.
17 Nobel Prizes.
Excuse me. I'm sorry. It changed. 1,200 economists, 17 Nobel winners. You tried to get the Inform Act into Congress for them to say, okay, we really owe something like $210 trillion. There's a real commitment here, folks. That, what a Ponzi scheme that is. And Congress still to this day won't look at it. You took out a full-page ad, I believe, in October of 2013 to talk about the Inform Act in the New York Times. Everybody in the mainstream media, just a big joke, just a big yawn, like this is going to be able to go on. And where are we with the Inform Act, at least trying to identify we're on the hook for 210 trillion. That's 200 million billion, isn't it? Did I get that right?
It's 200.
It's
1,000 billion, I think it is.
Yeah, 200,000 billion.
Yeah.
So 210 trillion is a lot. A billion is 1,000 million.
Yeah.
So I mean,
it's 1,000. Yeah, it's 210,000 billion. That's what it is.
210,000.
Yeah.
And then you're trying to get Congress to identify, hey, we're in deep doo-doo. We owe all we've committed to with, Obamacare and the military and Social Security and Medicaid, and Medicare, and everything. We've committed.
Yes, and it's 210 trillion above the taxes that the Congressional Budget Office projects to be coming in. So all these calculations are being done based on the Congressional Budget Office's projection. So the spending commitments exceed the projected taxes by 210 trillion. The official debt is only 13 trillion. So you got to realize that almost all of our liabilities are off the books in an accounting scam that's worse than anything Enron could have conceived of. Congress has been taking in money over the years and calling it taxes, but then making big promises associated with those taxes, for Social Security benefits, for me and for you, for Medicare benefits, for Medicaid benefits. They've also got commitments to defense spending into the future. So the entire economics profession, more or less, is saying, if you go to the informact.org, the very top people in the profession, almost every single American Nobel laureate has signed on to the Informact. We have to stop lying about the books. We have to put everything on the books. We have to do this fiscal gap, long-term, infinite horizon accounting that looks at all the expenditure commitments and all the taxes to cover it and looks at the gap. And that's 210 trillion. And to pay that off will require a 58% immediate and permanent increase in every single federal tax there is. So the country's bankrupt. We're in far worse shape than Detroit, far worse shape, I believe, than Greece at this point. And Wall Street hasn't, realized this. Otherwise, our interest rates would be sky high. But 78 million baby boomers like myself are going to be collecting, when we're fully retired, $40,000 per head. And that's baked into the future.
It ain't there. That's what you're saying. It's not there.
We're going to collect them in Social Security, Medicare, and Medicaid benefits. No, the money's not there. And
you're
so
just trying to get Congress to identify it. And they won't even, they're like, the monkeys, with the see no evil, see no evil, hear no evil, speak no evil. No.
Well, I believe that, I've talked to, first of all, the New York Times ran a column I wrote about this a few weeks ago, and that's on my website at kotlikoff.net, which is remarkable that they took an op-ed. It was because, they're a little to the left of center on their editorial page. And Paul Ryan and the House Budget Committee are looking very seriously at the bill now. So I'm hopeful that it will get passed, or at least by the House. And then we have to get the Senate to go along as well. But this should not be, what we're talking about here is our kids. This is not left or right. This is not some right-wing Tea Party attack on Social Security or Medicare, Medicaid.
This is just math. This is just general math that
putting the numbers together, seeing we got a big problem, and saying, look, if we want to have actually Social Security benefits and Medicare benefits, we got to make sure that these systems don't go broke. Yeah, we have to fix them fundamentally, those programs, but unless we address the deficit, the true fiscal gap the country's facing, we're never going to start the project of fixing things. So let's tell the truth to begin with and then go about fixing them. And that's where the purple plans come in at thepurpleplans.org. Our proposals, these are proposals to very simply and radically reform our tax, Social Security, healthcare, and banking institutions. And they would eliminate the fiscal gap at the least pain, but they would be radical changes.
Sir, you're doing great work for America. You're a great American. I don't mean to sound like Sean Hannity, but you are, sir, a great American, sticking your neck out. I know a lot of people probably want you to shut up and go away, and we have an election coming up and whatever, but thank you for being you, and thank you for putting out all this important information about SIPC and about to your words, a total insurance scam, and that we're in deep financial difficulty in terms of, the U.S. budget. Dr. Laurence Kotlikoff, a professor of economics at Boston University, thank you so much for joining us today on USA Watchdog.
Thank you, Greg. A lot of fun. Thank you.